Hi, this is Mark Curry, co-founder of SMK Capital Management, and today I'm pleased to have Mathew Hamlin with me. Mathew is a licensed CPA, and he's joining me today to chat about different IRS classifications of income, their corresponding tax rates, and why real estate investments can be a great way to reduce your taxable income. So thanks, Mathew, for joining me today. If you don't mind, maybe we'll just start with a quick overview of your experience and background in accounting.
Yeah, thanks, Mark. So, real quick, let's see here. It's been about 13 plus years I've been in public accounting, based out of Bend, Oregon. So lots of healthcare, lots of real estate, lots of construction clients and accounting situations that I've dealt with on the real estate side specifically. Spent a lot of time with real estate businesses and real estate investors, helping them out, figuring out what's a good investment for them, how the accounting works and how we can save on some taxes.
Great. Okay. Well, let's dive in, Mathew. I just want to review some questions we get asked a lot by investors. And we'll start maybe, why don't you review for us the three types of income, per the IRS and an example of each one of those.
Yeah. So we have essentially three buckets of income when we're talking real estate, right, Mark? So we have ordinary or non-passive. That's one and the same. Typically, I call it ordinary. We have passive income and we have capital gain income. So they're all taxed differently. Ordinary and passive are at the same rates, but have different treatments. And then capital gain, of course, has its own subset of, tax rate hierarchy. An example of both, ordinary is going to be if you're active in the real estate management, if you're active in the activity, you're going to get ordinary rates. This can be treated like any other business where you are actively participating. Passive is where you're not actively participating. Somebody else is managing the property for you, or you're a silent investor or a minority investor in a large accredited, real estate investment. And capital gains is you bought it for less than what you sold it for, and that's the appreciation side. That's just like stock. If you buy a stock from Microsoft, you buy it for $1,000, you sell it for $2,000, you have a capital gain. Certainly, the better rates are established at long term. So if you hold that for 12 months or more, then that's when you get that preferred capital gain tax rate.
Okay, got it. So active and ordinary income, which also could be, again, outside of real estate if it's a W-2 employee.
Certainly.
The active, ordinary, or non-passive income. And then you've got capital gain income and then passive income. So I think those are the three buckets. And then dividends, stock dividends, as example, are taxed as ordinary income. Is that right?
Yeah, that can even get more complicated of an answer, but there are some preferential treatment for dividends from U.S.-based companies if you are a U.S. taxpayer. But overall, yes, it's going to be an ordinary tax treatment.
Okay, great. So let's just review quickly. You kind of touched upon it, but let's dive in a little further on what are the rates for each type of income being taxed? What's the percent?
Yeah, for this purpose,
you just give us that ballpark range. It doesn't have to be exact, of course.
Yeah. For this situation, we're going to assume a high income taxpayer. The ordinary rates are marginalized, so at each level of income, you're going to pay a little bit more on the margin.
Sure.
The highest that starts at 10 and goes all the way to 37%. So in this case, if we're assuming high income, we're going to be at that at least 30 percentage, but could be as high as 37%. Passive is going to be the same. Depends on your income. It's going to be taxed exactly the same, and passive income that is will be taxed exactly the same as ordinary. And then capital gains again depends on income, but in our situation, we're probably looking at 15 or 20%. And that is just federal. Of course, if you live in a state where you have a state income tax, you have to bring that into consideration as well.
Got it. Okay, great. So ordinary and passive are taxed the same. That is, I think, a common misconception people may have. We get that question a lot.
The rates are, sorry, Mark, I don't mean to cut you off, but the rates are the same. We'll talk a little bit later about different treatments, how it's treated, but the rates, when it comes down to the bottom line, would be the same.
Sure. The benefit there, of course, if you're being passive, is it doesn't require your time to earn that income.
Yeah, that's a big piece of this. If you wanted to talk about that now, is that's why let
me ask a quick question. I get this a lot, Matthew, and we've discussed it, you and I, many times. But let's assume someone has a high active income, W-2 earner, business owner, doctor, attorney, etc. Can passive or capital losses offset that high active income?
Generally, no. This is where the real estate professional designation comes in. I'll touch on that here, in a minute. But generally, no. When you're high income, your passive losses from any activity, including real estate, would be limited or completely disallowed until you see other passive incomes. So that's really where that difference comes in. Is you could have a high W-2 or high ordinary income from an active business. That income, that taxable income, won't be touched, won't be negated by your passive losses, because the IRS has made that distinction. Those are two separate things. We don't want to allow, we being the IRS, we don't want to allow you to be not active over here, create losses and offset your active income. However, you don't just lose those passive losses. Those can carry forward, right? Until you have a passive income situation to eat into. So they're not lost, they're just deferred. And, I mentioned real estate designation. This is an IRS, real estate professional designation. This is an IRS designation that is critical. So for someone who spends a majority of their time, and there's a test, there's some hours and other things that they need to meet, and to see if you qualify, you need to talk to your own CPA. But if you're able to meet this real estate professional designation, it's a massive benefit to those in the real estate world, because you can start to take some, all, depends on your situation, of those losses, passive losses, actually against your ordinary income, which is, massive.
Yeah.
A massive tax benefit. So if you spend majority of your time in the real estate profession, you got to look into the real estate professional designation.
Yep, that's great. No, I agree. And let's dive a little further on the real estate, but let's also assume, Matthew, that folks listening, don't have a real estate professional designation.
Okay.
Let's talk about, how real estate investments can help reduce one's overall tax burden. And maybe we'll dive in and let's just go through a very easy to follow example, right? The most common would be that an individual buys a rental property. Assume that they buy it with a loan and some of their own savings. After the first year of owning that rental property, it's produced positive returns, positive cash flow. The investor has earned income from that property. So let's talk about that income that's been earned. How would that be classified and at what tax rate?
Okay, so it'd be classified, again, depending upon their activity. If they have a property management company managing the property, it's going to be a hard argument to say that's not passive. They are active with the property. There could be arguments that it's ordinary income. But let's assume, because in most cases it's going to be passive. Let's assume it's passive.
Yeah.
Especially if we are talking about an individual with a high W-2 or other, business that takes most of their time. So we'll assume passive. The big mistake I see a lot, in terms of real estate, is the assumption that cash flow is consistent with taxable income. It's not, for one major reason. It's a fancy word, depreciation. But it's a relatively simple concept, in that when you purchase that property, there's going to be, in most cases, there's going to be a building value assessed to that property, and there's going to be a land value assessed to that property. The land you'll never be able to appreciate. The thought is land never loses its value. Last time I checked, they're not making more of it, right? The building itself has a normal wear and tear. If you don't perform normal repairs, maintenance, in theory, that building's going to deteriorate.
Yeah.
That's where depreciation comes into play. In a basic residential rental, the IRS says, and I don't know where they got this, but the IRS says 27 and a half years. In 27 and a half years, that building's going to be dilapidated. So over the course of that time, you depreciate the purchase cost of that property, and you expense it on your tax return. So this does a couple things. First and foremost, it wipes out rental income, as does other deductions, mortgage interest, property taxes, insurance, HOAs, what utilities, whatever costs you have associated with that property. But the depreciation is a non-cash based deduction, which is a beautiful thing. So you've already purchased the property, the cash is out. If you purchased it with a mortgage, you actually probably didn't spend a lot of cash on it. But you're still getting this deduction that takes away from your taxable income. So you could have cash flow without the tax income. So that's the beautiful thing about depreciation. And usually when you're talking tax deductions, you got to pull your wallet out. So that's a major advantage of real estate.
Expand on that for me, Matthew. Usually when you're talking about tax deductions, you have to pull your wallet out.
Yeah.
What do you mean by that?
Well, other tax deductions, contribution to a retirement plan, you have to pay money in to get that deduction. If you're at, the highest tax rates and you're at a high state income tax, you live in a high state income or a state with high income tax, you could be in the 40s, mid 40s, pushing 50. You got to pay $1 to get 50 cents back.
Sure.
If it's improvements to your real estate, you got to pay money to get that deduction back. Where depreciation, say you purchased that building in 2019, paid or financed it, paid what was necessary to put down on the property, and that's it, done.
Sure.
You're still making your mortgage payments, of course, but that's building equity in the property. And in the background here, we have this depreciation eating in to your taxable income, but not eating into your cash flow. So it's a big distinction.
That's good. Okay. Yeah. And so just to kind of recap, rental property ownership could be passive or active, somewhat depending on who's managing it and how active of a role the owner is taking. And then, of course, the big takeaway is that there are a lot of deductions to the cash flow and the income that's received. And your net income, which is less all your expenses to operate the real estate, is further reduced by depreciation. And that is the big, I guess what I would say, specific advantage to real estate. And of course, one of the biggest advantages to help reduce your taxable income while earning income from these properties. So,
well, the idea of passive income, I think is a beautiful thing. I mean, regardless of if your passive activity is making profits, you don't have to worry about the passive loss limitation, right? What you have at the end of the day is income. Certainly, it'll be taxed. All income is taxed at some point. What you have at the end of the day is passive income that you made while you were sleeping or doing something else, as opposed to having to be there at your desk or at the trade or wherever it is that you're working. You have passive income that is generating without you having to do anything. And I think that is, kind of a dream scenario for investors.
Sure. Yeah, that's great. Okay. Now let's expand a little more on some of these advantages. Again, folks wanting to learn how to reduce their tax burden and how investing in real estate can assist in that. Let's talk about some of the strategies to reduce the amount of taxes they're paying. Thinking about it in a way, Mathew, where they might have multiple streams of income, potentially business owners, W-2, and also investment income. What are some strategies? Of course, we talked about the benefit of depreciation, but maybe you could share some more tax exchanges, what happens at death, etc.
Yeah, so there's lots of benefits to real estate. One, I'll start with the one that's most unique in that you can only do it with real property, which is the 1031 like-kind exchange. Prior to the 2018 tax reform, you could do it with personal property, equipment, et cetera. But they got rid of that. And so now real estate is the only thing that you can sell and defer the taxes on if you exchange it for another like property. And the like property is actually fairly broad. So that is huge. If you never want to pay taxes on your real estate or the appreciation of the value of your real estate, assuming the IRS continues to allow, and administrations going forward continue to allow that tax treatment of the 1031, assuming that stays in place, you in theory could exchange that property over and over and over again and die with it, and you never pay tax on that property, because at death your beneficiary is going to step up in basis, which means whatever the basis is, whatever the fair market value of that property is, your basis actually steps up to it. So in theory, you could sell it right after death. The beneficiaries could and see no taxable gain on it.
Let's go into a quick example of that, because I think that's a really important point. Let's assume purchasing a property and it's $800,000 and you bought it with a $500K loan and $300,000 out of pocket. Maybe 20, 30 years down the road, you pass away. That property is then transferred to your beneficiaries. Let's assume at that time, Mathew, just to make it simple, that it's worth 1.5 million, right? So the difference between your cost of 800 and 1.5, 700K, you put in 300 and you borrowed 500. What does that look like at the 1.5 value upon death?
Well, let's also assume that the mortgage at that point is paid off or pretty close to being paid off.
20-year loan, and at 20 years you pass, and the debt balance is zero.
Well, if you purchased it at 8, and I think you said the sell was 1.5.
Correct.
It's actually pretty straightforward. That basis of 800,000, your purchase price, original purchase price, gets bumped right to 1.5. So if you sell it for the market value at 1.5, you have a zero gain. So the beneficiaries would get to be able to cash out that property without paying any tax. Now, I do want to have the caveat of there could be an estate tax.
Sure.
But that's, that is not on the beneficiaries. That is on the individual's estate that passed. Okay.
Now, assuming you sell it at the same time, but you haven't passed away, you would then, of course, have a large capital gain. The numbers are the same, Mathew. Let's talk about the difference in capital gain and depreciation recapture in this using the numbers.
So in this scenario, assuming this property is a business or investment property, you are obligated to take depreciation on it. So even if you weren't to take it, IRS is going to make you take it. So it's an interesting kind of concept there. But over the 20 years, you would have depreciated the property, substantially, so that 800,000 in basis would have been depreciated down through the annual expense of depreciation.
Let's assume it's at 100K, Mathew, just to make it simple.
Sure. So let's say we took 700,000 then in depreciation, right? If I'm understanding you correctly. So our adjusted basis after depreciation at that point would be $100,000, and we go to sell it for 1.5. We have two different things going on here. We have appreciation that has created some gain, and we have depreciation that has created some gain. So the appreciated value, the 800 to the 1.5, that's going to get capital gain treatment. Okay, that's going to get our preferred treatment. The 800,000 to the 100,000, the depreciation is going to create $700,000 of additional income that needs to be recognized, because we've taken that $700,000 in prior tax years. What we're saying when we take that depreciation is the value of this property is going down. In reality, it went up to 1.5. And so we have to recoup or recapture that depreciation. Unfortunately, depreciation is an ordinary expense. So what that means is depreciation recapture is an ordinary income. So your depreciation recapture, that 700,000 in this case, is going to be taxed at your highest ordinary rates, where your capital gain portion, in this case, it would actually be another 700,000 from the original 800,000 purchase price to the 1.5 selling price, would be given capital gain treatment. So that would be a significant amount of tax when broken down.
And again, the capital gain tax rate is 15 to 20%. Is that about right in this?
Yeah, if we're assuming high income, it's going to be 20 at the federal level, and then you're going to have to tack on state there. So the two differences: if you use 1031 exchanges and you pass away with that property, zero tax outside of the caveat of estate tax.
So there would be no depreciation recapture at the time of death either?
Well, because you get a step up in basis.
In complete basis for both capital gains and depreciation recapture.
Step up in basis. So and again, remember that the estate may have a tax consequence. So I just want to make that very, very clear. But then on the opposite end, you actually have a total. If our adjusted basis after depreciation is 100,000, you sell it for 1.5. You actually have 1.4 million in half of it being tax, ordinary tax, and half of it being in capital gain tax. So that would be a lot. That would be a significant obligation there.
Sure. Yeah, it sounds almost a bit daunting. Like, why would you ever sell, right? What's the point of selling? Because you have a large capital gain and depreciation recapture payment due to Uncle Sam.
It's a cash flow consideration. If you want the cash now, or if you're tired, for some reason, if you don't want that property anymore, that would be the only reason. It would be if you want the cash out, then you're going to have to pay the tax.
Yeah, in today's marketplace, a lot of valuations have skyrocketed over the last decade. We're seeing higher valuations on assets than ever before, and so we have some investors that think, geez, I don't know how long this could really go on for. I don't want to keep trying to 1031 for the next 20, 30, 40 years. Maybe I'll go ahead and cash out on this investment property now, take some of the tax burden, and then reinvest the proceeds. Because again, in this scenario, you're looking at making a lot of money by selling, even net of the taxable consequences. So we have that conversation with investors. Should I sell it now? Should I keep it? What would I do with the money? How much taxes am I going to have to pay? And it's definitely important to look at the whole picture and make sure that if you are going to sell, it's for a purpose of benefit, right? And hopefully doing something with some of those proceeds that will benefit you, personally, financially, et cetera.
Yeah, of course. I mean, it's an individualized situation and discussion, but their real estate at the moment is the only way, in theory, to not pay taxes if selling or cash flow isn't a consideration for you.
Sure. Yep. Well, let's take it another step. Let's assume an investor wants to be a bit more passive. They want to invest in a partnership or a syndication, which groups investors' capital together, typically in a company or an LLC, and then that company and LLC will invest into the underlying real estate. And therefore, each investor owns a share of the total. In this type of scenario, assuming, again, we have cash flow coming in each year, above, of course, the total fixed cost to operate. Investors are earning some passive income from the investment. How is that, if it is at all, any different and on a tax standpoint from the previous example we went through? Just on the cash flow while you hold, Mathew.
Yeah. Okay. In terms of the passive income, passive loss, it's going to follow very similar to our simple example of owning a residential real estate property. If you're likely I think in most cases, based off my history, and knowledge, in most cases, investing through a syndicated accredited partnership, you're going to see passive because it's very hard for you to show active hours there. But again, I think that's a great thing because again, you're making money, cash flow. Usually, I can't guarantee that any investment will make money, but usually, based off my history, those accredited real estate partnerships provide cash flow while you're sleeping, and that's an awesome thing.
Right.
What happens there is because of the depreciation on these usually large complexes, real estate complexes, because of depreciation and something we call cost segregation, which I'll break up a little bit here in a minute. You're going to see the first few years with tax losses, which comes to the investor in the form of a Schedule K-1 that shows a passive loss.
Mm-hmm.
Now, likely, and again, based off my history with these accredited partnerships, you see cash flow still because you have depreciation and cost segregation front loading some deductions here that are non-cash deductions. So you still see positive cash flow back into your portfolio, and you see a no or reduced tax burden there. Again, same rules apply. If you have passive losses, you cannot usually apply those to ordinary incomes unless you have that real estate professional designation. But you don't lose them, they carry forward for you. So the key here is, again, cash flow without a significant or an increasing tax obligation, tax burden.
Okay.
So I mentioned cost segregation, Mark. So I want to talk about what that is really quick.
Let's do that.
Cost segregation, high level, is you have a large building, you have a large complex that's built, constructed, or even purchased, used. The purchaser has the option to go in, or the builder has the option to go in and break that large complex down into smaller depreciable pieces. All it is an effort to accelerate depreciation, because if you're able to find 5-year, 7-year, 15-year, in some cases, assets in that larger complex, then there is tax strategies available, Section 179, bonus depreciation, that the IRS allows to accelerate those assets into a 1-year depreciation. So front loading those expenses in year one, as opposed to having to wait all those many years to depreciate it. That's what cost segregation is in a nutshell. It is a effort, sometimes complicated effort, to front load depreciation.
Yeah, it's a benefit that we love to see and be a part of. We typically see it in larger, more commercial, institutional quality real estate. Think about 200-300 unit apartment communities, mobile home parks, which also have accelerated depreciation on a lot of the fixtures and utilities. The roads, they can be depreciated at, I think, about 15 years. But also the cost segregation you're noting on apartment communities specifically, a lot of our operating partners will hire a cost segregation expert, the day that you close on the property, to go in and assess the property. They'll walk through numerous amount of units, apartments, exterior, interior, and they're taking notes on what type of furniture, what type of fixtures, carpeting, flooring, light switches, etc. there are throughout the property.
Yep.
Appliances as well. And each one of those items, again, if you think 200-300 units, if you've got 200 refrigerators, that's a good amount of capital that can be depreciated, typically 5 to 7 years versus 27 and a half years.
Right. And in reality, they take that 5 to 7 years for those refrigerators to 1. Because of those Section 179 and bonus depreciation tax benefits available.
That's great. So I want to share a screen, which is a table that we put together that I think will help visualize a little bit of what this all means. And in theory, what it is investors earn cash distributions. That's money that's coming into them. And at the end of the year, they're going to report an amount of taxable income on that investment income that's been received. And a lot of times there's a big difference in the amount you receive versus the amount you report. And we have a few examples that I'm going to share here. Before I do, let's all just remember that past performance is not an indicator of future results. And we're using this as an example. These are real investments that we've made and do paint a really good picture of the difference between distributions received and taxable income reported. So we've got this table here. You'll see there are 6 different examples. We broke them out into 3 different asset classes. The first is mobile home parks. The second is multifamily or apartments. And the third is self-storage. And we won't go through all the numbers, but you can get a pretty quick sense of what's happening here. We are earning cash distributions from each of these investments, and the amount that's actually reported to the IRS, of course, is significantly less, and oftentimes there's some losses as well due to the tax and IRS code allowing us to take advantage, of course, of depreciation and cost segregation. So I'm glad we were able to share this table, Mathew, because I think it really puts it into perspective.
Yeah. And it's a great reminder that tax doesn't necessarily follow cash flow, especially when you're talking, real estate. And that's one of the nice benefits of real estate is you can put money in your pocket, and the passive investment, worst case scenario, if it generates a taxable loss, does no harm. It doesn't create any additional tax burden. Best case scenario is you have maybe some other passive income from another partnership that's aging. What I mean by that is it's starting to generate cash flow to the point where it's actually showing profits, and that passive loss can eat into that. So in an ideal situation, you have, let's say you invest in one of these syndications, right? You invest in, I'm going to call it apartment complex A. And you get some cash flow, some passive losses from that in the first few years. And then year 5 or year 7 rolls around and you're seeing more cash flow and you start to turn profitable. Okay. You get to eat in the passive losses for those first few years. But then if you take those profits and put it into another investment, the first few years of apartment complex B, those losses could in theory then eat into the profits of apartment complex A. And what you've created is 2 different sources of cash flow that maybe wipe out the tax burden in portion or in totality. And again, this is while you're sleeping. So is it, like I said, there's no guarantees. It's not foolproof, but the experiences I've had with them, are pretty appealing.
Yeah, that's great, Matthew. I'm glad you kind of put that in context. Over time, if you have a model of consistently investing, passively in these types of real estate investments, syndications, partnerships, and you tend to stack them over the years, they can play against each other. So if you have, for example, like you just said, let's say apartment investment 1 sells in year 7, you have a large gain. You may have several other investments that are reporting losses that can help eat away some of that gain.
Yeah, sure.
It's a big investment strategy of ours. It's pretty much exactly how we like to do things. So I'm glad you brought that up. Great. Well, I just want to kind of summarize. I think we've talked a lot about a lot of details today. We've gotten a bit technical, but hopefully not too much, where people can understand and see the benefits. And for me, I look at some of the takeaways that we've gone through, and allow you to, of course, tell me what you think as well, Mathew. But income producing real estate investments can increase your total income, but the taxes that you're paying on that real estate income can often be very low. Let's just call it that. So the result is you're decreasing your overall tax rate because the total tax amount being paid isn't going up that much while your income is. Is that a good way of summarizing it?
Yeah, the to put it another way, I mean, your passive investments will never reduce your ordinary tax marginal rate, but it actually, in theory, it reduces your effective tax rate because you're having more income with a lower or less quickly increasing tax burden. So in that case, it lowers your effective tax rate, meaning how much tax did you pay to your total dollar of income. Yes.
Right. Yep. That's great. Well, I appreciate that, Mathew. Any parting thoughts that you want to share with us today?
No, I just want to say thank you for your time, Mark, and allowing me to come in and chat on this. And that my contact information will be put up shortly. And if there's any questions, I'm happy to answer some emails or talk over the phone as necessary.
Sure. Yeah, appreciate it, Mathew. I will switch screens here and let everyone see our contact info. If you're listening today, feel free to reach out to Mathew or myself directly. We're both readily available, very passionate about what we do, and we'd be happy to help. So, Mathew, thanks again for your time today. It's been great.
Yeah, appreciate it, Mark. And I guess I'll do the other CPAs some service here in saying, if you're working with a current CPA, chat with them before making any commitments to any short or long-term investments, because they probably have some thoughts before you jump in.
Yep. Well said. All right. Thanks again, Mathew.
All right, sir. Yep.
Right.
Thanks, Mark.
Take care.
Bye-bye.
Bye-bye.